All right, Larry, welcome to the Proof of Thought podcast. Yeah, super excited to have you here today and dive deeper into all of your ideas around the economy, governments and central banks, and hard money assets like Bitcoin and gold. On the show, we break down topics and really try to understand things from first principles thinking and aim to give constructive alpha to our listeners. So we'd love to dive in with you.
Charles, really nice to be with you. I like the title of your podcast, Proof of Thought. Fits nicely with proof of work.
Thank you. Thank you.
Yeah,
Yeah, so I recently read your book. I actually have it here with me today, The Big Print. Uh,
excellent.
yeah, where you walk through how and why the Federal Reserve was created, its evolution, and how, especially in the decades following the 2008 financial crisis, its role expanded significantly. Through policies like quantitative easing and prolonged interest rates, the Fed began to exert deeper influence over financial markets and the broader economy, effectively creating what is called a Fed put under financial assets by supporting them during markets of turmoil. You argue that these actions led to serious unintended consequences, from asset bubbles to increased wealth inequality, and you view Bitcoin, the hardest asset, as the key solution. So, before we dive deeper into all of that, for those unfamiliar, when did you personally decide to become a serious Bitcoin investor and advocate? And when did you first sense that the next big overreach, what you call the big print, was coming? Can you talk about this shift in your thinking in the context of the Federal Reserve, Treasury, and Congress and their historical evolution and where you see them heading today?
Yeah, that's a great question, Charles. It'll take a little while to explain it, but I kind of evolved. Nothing. You don't wake up one morning and go, "Oh, I'm a full-fledged Bitcoiner." You kind of ease your way into it, or at least that's what I did. And I bought my first Bitcoin in 20. I was aware of it in 2011, 12. Not really super aware, but I was aware that it was there. And my initial skepticism was driven by the fact that eCash and DigiCash and Hashcash and other things like it had failed. I mean, throughout the 90s, after the internet was developed, the 80s and 90s, there were alternative cash systems that were being proposed that more or less they all failed. And so the notion of separating money and state has been around for a while, but nobody successfully did it until Bitcoin. And so when I first heard of Bitcoin, I had a natural reaction with like, oh, that's a nice idea, but it won't work just like all the other ones. So I kind of like people today, the way they throw Bitcoin in with all the other crypto, they don't realize there's a difference. But so I started toying around with it 2013 or 14, but I kind of forgot about it. The next thing I knew, it was up 3 or 4x what I paid for it. And I thought, shoot, this is really working. It hasn't broken, and maybe I need to pay attention to it. So I started digging in deeper. And, the more I dug in, the more I realized that it was technologically sound, and my fear of technical failure, which was my initial concern in the early years, slowly faded away. But we went through some things. We went through the block size wars, and there were several hard forks, and none of them really took. But there was a lot of, in the beginning, it really was very much viewed as an experiment. And I went to a show in 2017, and then in 2017, I by 16, 17, I was taking it seriously and buying more of it. There was a big run up in the fall of 17 up to 17,000. We all thought it was breaking free. I bought it at 17,000. It immediately turned around and collapsed to 10 and then down to 4. I bought more. And, so I followed it all along and kind of overlay that with, on the other side of my life, I was an investment manager from the time I graduated from HBS until, well, really till today. And I actually had focused on technology and investing in small tech companies in the venture capital world, mostly private companies that ultimately went public. And that was a good area to be in from, the early 80s until, 2004 or 5, because there was a lot of technology change, a lot of developments, a lot of companies grew very big. And so the funds I was involved with did real well, and that all worked out great. In 2000, the dot-com bubble burst, and I got in early on dot-com. I was buying things in 93 and 4, private internet companies, because I was fortunate enough to learn about it before it really became a thing. And those worked out really well. We made a ton of money. And But in 2000, it was obviously very overdone, very bubbly, very frothy, and we're trying to sell everything that wasn't nailed down. Of course, then the bust came, and all those crazy valuations came back down to earth. And so I kind of thought this is a pretty good time to kind of shift gears. And my family wanted to move. We were in New Jersey. We wanted to move back to Boston. So we did that. And I changed firms, and I set up my own investment firm focused on investing in what I call growth at a reasonable price, which is, companies that are growing. I mean, the thing that worked the best in the technology field is when you found something that had revenue momentum and the multiple was still cheap and it had a lot of growth in front of it. What would happen with those is the multiple would expand and they continue to grow. And so you got outsized returns. So I wanted to try and do that in other areas and set up my own firm to start doing that. Was doing some things in China and India and so forth because they were growing. And then the GFC came along, and the GFC kind of really shocked me. And it didn't shock me that it was happening. I was actually short a lot of the tech stocks going or the housing stocks going into it. But what shocked me was the government response, where they said, "Oh, we're not going to let this stuff fail. We're going to print money and give it to the banks." The banks paid record bonuses 1 year later. And, Ben Bernanke had a chance to test out all his helicopter money speech ideas, which is to say he took interest rates to zero, which really had never been done before. And he started quantitative easing, which was basically, buying bad bonds and bad securities in order to inject money into the system, and was really just a form of the government printing money. And I was I was stunned at these things. I was like, oh my God, I can't believe he's doing this. We're going to have a ton of inflation. And I was right and I was wrong. I was right that we did have a ton of inflation, but the inflation went into assets. It didn't go into the consumer prices because the money didn't actually make its way through to the consumer because the banks weren't really lending it out and growing the money supply. It was more a case of it was sitting on bank balance sheets and everyone was using it to speculate as a carry trade. And so, so I saw all that, and that, that was when Bitcoin was just getting founded. As I say, I wasn't really focused on it, but I just watched over the next 10 years from '08 to 18 as, more and more money got printed, and more and more the financial system became impaired, and Bitcoin did better and better. And it became clear to me that, they were trapped and that they were going to have to continue to print money. And in fact, as an Austrian, having studied the Austrian economists, I kind of knew that intrinsically, there was something wrong with the picture. And the thing that's wrong with the picture is that you can't grow the level of debt faster than the level of GDP without eventually having the two disconnect and having a problem. I mean, that's, you're going to have the debt's going to fail, or you're going to have to grow GDP very quickly through inflation to support the debt. But there's no mathematical solution for what they were doing. And so it became very clear to me that monetary debasement was now a feature, not a bug, that they were going to have debasement on a go forward basis for a long time. And so after '08, in my fund, the fund I was doing things in China and India with, we pivoted, or I pivoted and started. I said, okay, we're going to have inflation here. What do I want to be in if we have inflation? And it's very clear. I looked at the last inflationary decade, which was the '70s, and the two best performing categories in the '70s were oil and gold. And so I thought, well, I'm going to invest in gold, but gold's pretty dull. It just sits there, it doesn't grow, it doesn't pay dividends. So I thought, well, I'm going to invest in companies that mine gold. That's interesting. And so I became a specialist in picking gold stock companies, gold mining companies as stocks. And it did quite well for a few years. And then we had a big correction, and that was quite a setback. But the long story short is that I pivoted towards sound money. And as time went by, I came to realize that Bitcoin was an even better form of sound money than gold. Gold was good, 5,000 years of history, can't be printed, slow growth, 1.7% growth per year in the supply. But Bitcoin was even better because it was on a rapid adoption curve, and I call it digital gold, really. And it's actually better than gold because the stock to flow is now lower and will get lower every 4 years going forward. So, and as we all know, it's capped, algorithmically capped at 21 million coins. So I foresee a future where, Bitcoin just continues to go up in price for a very, very long time because it's a limited digital asset, that's becoming a store of value. So that's kind of how I got to where I am right now. And of course, now I'm a full-fledged Bitcoin maximalist. But unlike some maximalists, I'm not anti-gold. Gold is fine. It's less volatile. For some people, it's easier to hold or better to hold than Bitcoin. But to me, it's old-fashioned sound money, and Bitcoin is modern sound money.
Wonderful. So you talked about the Fed lowering interest rates to zero, government printing money after the crisis, and that leading to asset inflation. Are we all effectively playing a game of musical chairs where the Fed and Treasury control the music or asset prices through monetary policy and Congress through fiscal policy? How do you think about that?
It sure feels that way, doesn't it? I mean, the book I wrote describes the way that the Fed got put into place by Greenspan following the '87 crash. And it's the Fed has two mandates, stated mandates, stable prices, which they define as 2%, and then, healthy employment or full employment, which I think they define as, 2 or 3% unemployment. And but they really have a third mandate, which is stable financial markets. And what we've seen historically in their behavior is that whenever the financial markets get a little bit rocky or there's a problem, they'll step in. And by step in, I mean they'll print money to smooth over the problem. And so systematically, we've really got something that's built to inflate. It just has to inflate, and that's a very big disadvantage to the working person whose wage typically doesn't go up at the same rate as the cost of living. So, and it's an advantage to the people at the top of the system who are financial actors and who know how to borrow and leverage and do all the things they do to extract value. They're able to actually make inflation work for them. It's a good thing. They'll borrow knowing they'll pay back in dollars that are worth less, and then they'll invest what they borrow in something that can go up in price faster than the cost or than their interest costs. So, and this is why we've got the wealth inequality that we do have today in America. I mean, it's really unbalanced, so particularly when I compare it to the America that I grew up in the '70s. I mean, it's just they're just there's billionaires and there's everybody else, and the bottom half of the everybody else is kind of hurting. So, and that's because the money is broken.
Yeah, and we'll definitely dive a lot deeper into these topics. You did mention Greenspan, though, and I want to really understand your thinking around this. In your book, you pointed out that the roots of the global financial crisis actually go back to 2003, when Greenspan slashed interest rates to 1% after the Dodd-Frank
Right.
crash. So,
Yep.
following the GFC, as we talked about, we had 0% interest rates for nearly a decade. But if low rates through Fed operations is the core culprit here, where's the big crash now as a result? In fact, the economy, one could argue, has boomed over the past decade or so. Housing prices have recovered. The stock market has had one of its best stretches in history. Or is it just that there's been a massive delay?
So the record stock prices, the housing market, employment market, everything being strong. I mean, that's you dump 40% of the money supply into the system in 2 years, which is what they did. M2 went up 40% in 2 years, and guess what? Things are going to look good from a growth, spending, et cetera, point of view. What they don't look so good from is an inflation point of view. I mean, as we know, when they did that, inflation went up to 9% at one point. Now they've squeezed it, and theoretically it's coming back down with these higher interest rates that Powell has put in. But we all know, one, the inflation numbers are a little bit cooked, so that probably what they're coming down isn't entirely numerically accurate. You know, I think that while the economy looks healthy and has been ticking along, I think underneath it all, there's a decay taking place, and you see that in statistics like credit card delinquencies and student loan delinquencies and houses days for sale, number of houses on the market. I mean, I feel like all that stimulus, provided quite a jolt and a positive jolt for a couple of years. But we're now at the stage where it's going to wear off, and they've either got to take another hit of stimulus, or we're going to enter a downturn. And what's troubling is that we're running a 6 or 7% of GDP deficit in an economy that's pretty healthy on the surface. And I think that once that economy rolls over, that deficit could get much larger, and that's gonna create a problem for the Fed, because interest rates will go up, and then the interest expense will go up, and the deficits will get larger. I mean, in broad terms, what we're observing here, Charles, and it's not something anyone alive has ever observed before, because the last time this happened was World War I in the 20s. But we're really kind of observing a sovereign debt crisis. I mean, we've seen it in smaller countries. You've seen it in Argentina or Brazil or Zimbabwe or Venezuela, but you haven't seen it on the world stage with a big industrialized country before, like ours, for a long time. And so that's why I think people are having a hard time reading what's exactly going on.
Well, if these aggressively low interest rates are a mistake that leads to boom and bust cycles, why do they keep following this path? Aren't these, smart and very educated people?
You would think. Yeah, you would think. I mean, it serves their interests. I mean, if you're a financier and you know what the playbook is, and you know when they're going to take them up and when they're going to take them down, you know which side of it to be on, you can make a ton of money. I mean, and there's a lot of evidence. I mean, Trump with these, we're going to tariff everybody, and maybe he told people that, and a lot of people in government got on the short side, and then no, we're going to put a 90-day pause on tariff. We had one of the biggest rallies ever. So, there's a lot of tomfoolery that's going on, with these different policy moves that they're making.
Yeah. But how would you respond to someone like Warren Buffett, who's on record saying that the government's response to the financial crisis and COVID, although not perfect, was necessary? But you argue that the government should let maybe pure capitalism,
I
clear out
do. I mean,
this
I
during.
don't dispute the fact that, they scared everybody into thinking the ATMs wouldn't have worked and all the banks would have failed overnight. And that's entirely possible that that might have happened. And so we'll never know because we didn't get to play it out, right? But what I did suggest in the book, I wrote I think it was a footnote or an area, or no, it's a couple of paragraphs where I talked about it was, what they should have done is clawed back compensation from the banks, brought in new management teams. They shouldn't have rewarded the people, stopped letting the bank years, et cetera, et cetera. They shouldn't have rewarded the people who brought on the crisis. I mean, that just made no sense. And, was just grossly unfair. So, yeah, part of the error I think they made there. I mean, okay, so you got a crisis. It's big. I get it. You got to solve it. Fine. You got to print a lot of money, take interest rates. I get it. Okay, now it's 2011. Crisis is 2 years away. World hasn't ended. Everybody's kind of working away. Well, why are interest rates still at zero? Do you know what I mean? Why? Because they ran that policy from '08, late '08, all the way to 15, and then they ever so slowly started creeping up. So that's 7 years of free money, basically. And that's a real distortion. And not just 7 years of free money, but 7 years of growth in the money supply as a result of the QE transaction. So it you know it's a broken system, and as I argue in the book, interest rates should not be set by a policymaking group of 12 people sitting around a table. Interest rates should be set at the point at which there are people who save money and they want to earn interest on the money they've saved, and then there are people who need money and they're willing to pay interest in order to access that capital. And so my view is that should happen in the free market between willing adults on both sides of the trade. So somebody says, I want to do this. If I do this, my business will do that. Will you lend me the money? And what are you going to charge me? And you can have a first lien on my business. Well, maybe I'll make that loan. And so I think the marketplace would do a much better job of taking care of interest rates and loan allocation than a committee of 12 people.
Mm. Oh, very, very interesting. And so, yeah, perhaps there shouldn't be a group of individuals who set this that should be left for the markets. With the '08 crisis, maybe some of the initial stimulus was needed, but lasted way too long. What about C-19 though? As we think about, you point out in the book that if we thought the '08 the stimulus during '08 was big, then what happened during C-19, that was just a whole nother level, actually. I think
Are you talking about when the repo market blew up, or?
yeah, and then I'm also talking about when it comes to the CARES Act, the PPP
Oh
program,
yeah, sure. Oh,
billions in
COVID. Yeah,
stimulus
yeah.
checks. And so,
Yeah, no, I mean, it's funny. I've titled the book The Big Print. Well, we've already had two really big prints, right? One of them was '08. They printed about 3 trillion. The other was, COVID. They printed about almost 5 trillion. So I think we got another one coming. I think it'll be bigger, as is the pattern. Yeah, I mean, COVID was pretty outrageous. I mean, again, no doubt, they needed to do something. My view is they should have tried to keep it very focused on the industries that were most directly hit, airlines, restaurants, and hotels. There were a lot of businesses that did not need the loans, but that got them, and then they were just granted the money, which is inflationary. The stimmy checks went to the people, but there really wasn't that much per family. I mean, a couple $1,000s per family isn't going to change somebody's life. And yeah, it was poorly done in my view. I mean, there's about $18,000 per family in the United States of money that was printed or stimulus that was given in the COVID example, and the average family only saw like 3,000 of that. They got their stimmy checks, and then maybe if they qualified, they got some unemployment checks. So that other 15,000 went to wealthy business owners, some of whom needed it, some of whom didn't. But it was a bribe to try and keep the whole thing together.
hmm, interesting. So, are you then suggesting or saying that if in terms of interest rates, that should be handled by the market instead of a central bank. But in terms of crisis, there still needs to be some sort of government stimulus. And so we should then kind of have that responsibility be held to Congress in terms of stimulus and not do anything to like lower interest rates to help stimulate things.
Yeah, I mean, I think that's probably right. I mean, honestly, I think we should, scale government way back, and we can all see what's going on right now, where they're just spending way too much money. But yeah, I mean, I think there's an argument. I mean, interest rates in this country, have gone from extreme to extreme. Volcker took them to 20% and almost bankrupted my dad. The GFC happens, or the housing finance thing bursts, and they go down to 1%. Then the GFC happens, they go down to 0%. I mean, one could argue they'd almost do better just set them at 4%, just leave them there. Do you know what I mean? Don't mess around with all these wild swings. I mean, and by the way, in their defense, I don't think God himself could set the right interest rate. I mean, it's a market function, and so you ought to let the market set it. That's the whole thing. I mean, the Russians they tried in their great development plan to set all the prices, and it turned out it didn't work. And that's part of why Russia failed. Prices are best set in the free marketplace. So yeah, that's where I am on that.
Okay. Well, let's move on to 2023, the banking crisis. I think the most well-known one is Silicon Valley Bank. There was a Fed intervention there and Treasury intervention, but they handled it a little bit differently. But before we go there, this next question is a little more technical. So if you could help break this down for the listeners to give a good understanding of this. But banking regulations, as you point out in the book, were moved from mark to market to mark to maturity through a regulation change during the GFC. However, it was the held to maturity rule, so that changed that
They got Silicon Valley Bank in trouble, right?
right. So, when the Fed raised interest rates and bond prices fell. So, can you explain this, given you also mentioned that that same rule change actually initially aided the banks? So, wouldn't SVB have also failed if their bonds were being marked to market at the time? Or,
Yeah, I don't know, because I don't know how many bonds they held in 2009. But yes, in 2009, things were very, very bleak. And even with 0% interest rates in QE, there were still banks that were not trustworthy and on the verge of failing. And so they changed something called FASB 157, where, as you described, they allowed people to carry things at whatever they wanted to carry them at, and saying, well, we're going to hold it till maturity, so you can't mark it down now, even though it's trading at much less than that today. Which was really, in my view, kind of fraud or fraudulent, because it's not being completely honest about the balance sheet of these banks. But anyway, they did it, and that led to the banks surviving. But some of them, like Silicon Valley, did stupid things. They bought low yield, long duration bonds, which, when Powell finally realized that, we've got an inflation problem and the good ship inflation is not transitory, as he said, which I thought was really kind of insensitive, that he had to raise rates really quickly. And when he did that, the value of those bonds held by, some of those companies that had bought them, you got severely smashed. And honestly, I think this is a case of the trend is your friend. I think there's just more of this in the future. We lived in a deflationary world from the 1980 timeframe all the way to 2020, March 2020. I think in March 2020, we hit peak deflation. I mean, we had negative yielding bonds and all kinds of crazy stuff. And so, boom, COVID comes along, and now we've shifted gears. We're going the other direction. I think we're in inflation. I don't think we've hit the peak yet. And the reason I say that is just that there's so many cracks in the system, and the only way to solve them is to print more money. So they will.
going to be interesting.
It really
Sticking,
is.
yeah, sticking to the banking crisis situation, 2023. So the regulators at the time, as you point out in the book, couldn't necessarily orchestrate a typical bailout. The Fed and the Treasury,
Right.
they used what was called a systemic risk exception. So actually changing the language, but buying assets from the banks that had failed to essentially have the same result and effect. So, what can everyday people look out for to be aware of these future bailouts and money printing periods if the
Well,
regulators
I think what I think it's interesting, because there's a lesson in what you just described. Okay, let's talk about that. So, when 2008 happened, the banks got bailed out. People were pissed. I mean, I remember it very well. It was Occupy Wall Street, the Tea Party. I mean, people were really pissed. I mean, they were like, "Hey, this isn't fair. I lose my house and the bank gets a bailout. What's up with that? No bailout for me." I had a picture of that in the book, actually, about a guy who suffered that way. And so that led to creating a law called Dodd-Frank, which said we're not going to bail out the banks anymore. If the banks fail in the future, we're going to let them fail. And, the equity holders will get wiped out and the bond holders have to take a haircut. So along comes Silicon Valley Bank, and exactly what we're describing happens. It's failing because they bought all these bad bonds. They're now getting marked to market. And, Dodd-Frank said what should have happened there is the Silicon Valley Bank depositors should have taken a 20% haircut because that's how big the hole was. Well, the Silicon Valley Bank depositors included Bill Ackman, who's a billionaire in New York City, who said, you don't bail this thing out, all the banks are going to fail. And by the way, he might have been right. I mean, there were a lot of people every CFO in America was looking at their bank and thinking, gosh, if I have more than $250,000 there and it fails, I'm going to, I might lose money. Right. And so that fear led Janet Yellen to pull out the systematic card and say, well, I know what Dodd-Frank says, but it doesn't matter. The systematic card overrules this because turns out there's $17 trillion of bank deposits. And if we'd had a bank run, that's the central bank's worst nightmare. So they did. They basically guaranteed everything. They guaranteed Silicon Valley. They guaranteed First Republic. They forced them into mergers. They tried to sell them off originally, and everyone looked at them and said, we're not touching this. This thing's got a big hole in it, right? So there are no buyers. But then, they ended up giving subsidies to the purchasers and said, look, if you buy this, we'll give you a break over here. And so they found buyers for both of them. So, I guess what I'm trying to say is at the end of the day, the government will always find ways to keep the system going to protect itself. Those ways of doing that will always involve printing money, as they did in those cases. That printing money will always lead to inflation, as it has, and will continue to do. And so, as an investor, as an individual, what's the bottom line? The bottom line is you've got to own things the government can't print, forms of money that the government can't print, because the government can print dollars, the government can print debts, so to speak, but the government can't print gold. The government can't print Bitcoin. They're physically, one is physically limited in supply and the other is mathematically limited in supply. And so because of those limitations, compared to everything else, they will appreciate in value very rapidly. And they have. I mean, we're in a sovereign debt crisis. And since the beginning of 2020, the price of gold is up, 250%. And the price of Bitcoin is up almost 2,000%. So, you actually have the marketplace telling you loud and clear, we don't trust the federal government to have their finances under control. We just don't. And we saw that this week. I mean, look at Elon Musk, tried to do the right thing, went in there, said they're going to cut a ton. Well, maybe we'll cut a half a ton. Well, no, maybe we'll cut a couple $100 billion. And this week he throws up his hands in disgust and says, you know what? This is so friggin' broken that it's never going to get fixed. We can't cut anything. And so, it's just, it's hopeless. I mean, it really, in the current government construction we've got now, I'm not saying that won't change. It could change, but I don't think, I don't see it. I don't see an imminent change. But the point is, in the current government construction we have, all roads lead to money printing. They have to print money to keep the system going. So, they will print money. And that's why the title of the book is The Big Print, because there is going to be another one, and it's going to be very inflationary when it comes. And so the first part of the book was to lay out the history of how all this happened. The second part of the book is, okay, given what you now know about that grim history and extrapolating out what's likely to happen next, where do you want to be positioned? You want to be in sound money alternatives, because if what I'm thinking happens, the sound money alternatives are going to go up by multiples of their present value. Gold's going to go to 10,000 and Bitcoin's going to go to 1 million. So, that's kind of where you want to be. I mean, owning stocks, it's okay. The businesses will reprice in whatever the new currency is. But in general, when you have a currency event, owning stocks is not a great idea. Despite the fact that the Venezuelan stock market was one of the best performing markets ever during the year when they were undergoing hyperinflation. Good luck getting your money out.
Hmm.
So,
Yeah, another question here about SVB, because really just trying to understand what should the at least immediate term solution be, right? So, as I understand it, you are also a customer at SVB, yet it seems like you believe the government should have let, again, here, capitalism play out and allowed SVB and other impacted banks to have run their course.
right.
Can you walk us through your thinking about this? And just to clarify, were your deposits with SVB insured at the time?
Well, they were, because I didn't have over 250,000 in there. But to be totally fair, I mean, I mean, and this is also one of the reasons why they use the systematic risk exemption. I mean, the FDIC, which provides that deposit insurance, right? I mean, there are $17 trillion of bank deposits in the world. And I think most of which are uninsured. I mean, there's a small number that are below the 250, but many of them are not. And the FDIC fund that they use to to make depositors in failed banks whole last time I checked, it was like in the 190 billion range. So compare 190 billion to 17 trillion. So if some meaningful portion, even if only 10% of the 17 trillion were in banks that failed, that'd be 1.7 trillion. You only got 190 billion to cover it. I mean, the FDIC is woefully underfunded. And so, they had to do it for that reason as well. And in my book, I talk about why we should eliminate the FDIC, and basically we should force the banks to be responsible. I mean, a lot of this problem has occurred because banks behave in an irresponsible way. These boom bust cycles are driven by banks, lending, getting too far out over their skis, making bad investments. The bad investments go south, and then they come crying to the government and say, you can't have me fail, or else your whole economy is going to go down. So give me money. And the government finds a way to give them money, and that money becomes inflation, and your groceries cost more. I mean, it's that simple.
Yeah, it's almost like this cycle that maybe perpetuates itself
It
because
does. I mean, we've seen it over and over and over again. Yeah.
yeah, yeah, exactly. And you'd imagine these bankers that you're talking about, the people closest to what's happening, also have strong connections and ties to
Oh, yeah.
or
Sure they do. Yeah.
policies. So,
Yeah. Yeah.
but another thing here, can you talk us through? This one's a little bit more technical too, but can you talk us through what happens to the assets in situation where the Fed buys assets for cents on the dollar, like they did in SVB?
Yeah.
Exactly who do those assets belong to? When they're eventually sold off, does the money stay with the Fed? Is there a world in which the Fed could maybe hold those assets to recovery on behalf of the American people,
That's
thereby?
a good idea. Yeah. And there has been some of that. And they did make some of the money back that they lent out during the TARP stuff. I mean, they got some of what they put out back, but not all of it. Some people say they made money out. I don't think that's true. But yeah, so look, they warehouse the assets on their balance sheet, and they're calling them fair value assets, and, but they're generally warehoused at a value above and beyond what they're really truly worth in the market. I think when the day comes, if they do recover and they are worth a certain amount in the market, well, then they can sell them and let them run off. But that's reducing the money supply. And so my sense is it's kind of a roach motel. Whatever assets they buy, they just end up stuck at the Fed. But I'm not 100% sure that's the case. I mean, there may be some that have been sold off, but um, you know the the system is like a shark. It's got to keep going forward to breathe, and so you got to have more money and bigger balance sheets and more circulating credit, or else you can't pay back the old stuff. And that's why some people said it's a Ponzi scheme, because you have to continually bring in new money into the system to make sure that the old money stays, quote unquote, money good, that
Uh,
it doesn't fail.
That's funny
There's
because
never,
I thought Bitcoin was a Ponzi scheme. I don't
yeah,
believe
well,
that.
that's what everybody says, but who's the Ponzi in Bitcoin? I mean, in the Ponzi scheme of the money being run by the banks and the government are the Ponzi. I mean, they're benefiting because the banks get free profits, and the government gets financing for all the stuff it wants to do so that they can all get reelected. And meanwhile, the consumer, you and me, see inflation and see our grocery bills go up. I mean, it's just that simple. So it works. Yes, it works for the insiders, in the government and the bank. And my book describes this in great detail, how it's kind of a cabal of people who defend this system because they really benefit from them. I mean, being a banker's a good business if you can't fail.
Right. Hey, so the big issue here is that governments have been and will continue to print excess amounts of money, essentially
Correct.
increasing debt to GDP to unsustainable levels, as you've touched on, which
Right.
risks triggering a debt crisis. And you make the case that that becomes ultimately a currency crisis. Those are your words
Correct.
there. So, can you break down what that means and what the implications are? That sounds like a big problem that we haven't experienced here. We've seen it in other places of the world, but to imagine that.
Yeah, well, when you've seen it in other places, I mean, generally what happens, it starts showing up in the bond market. People, currencies, well, let's go back to first principles. Currencies exist because of trust. People know what a gold coin is. And so people, it's been around for thousands of years. They know that there's a limited supply of gold in the world. So they attribute value to gold coins. They trust gold coins, and they trust trading with one another in gold coins. Fiat currencies replaced gold coins over the years, and It really came down to trusting that the government would be responsible, with the printing of that currency. And in many cases, governments were responsible, and so the currency was trustworthy. I mean, since Germany suffered the hyperinflation of the 20s, I mean, the German, Bundesbank was one of the most conservative central banks in the world. And, the German mark was an extremely strong currency post World War II, all the way up until we got into the real late stage fiat post 71. The Swiss in the same situation. Their currency was very, very sound. But the trust in the currency is really like saying the trust in the politicians and the central banks, because the politicians and the central banks manage the currency. They have the ability to change the reserve requirements. They have the ability to push the interest rate up and down. They have all kinds of powers and ability. They have the ability to bail out a failing institution, which is what they did in '08. They have the ability to print money. And so once you give all these abilities to the central bank and the government, and they're really kind of, hipped at the joined at the hip, so to speak. Once you give all these possibilities, all this power to these people, you got to believe they're not going to abuse it. And the fact is, there've been a lot of examples of how they will abuse it. Oh, well, just a little bit. We'll just, we need to keep the wheels greased. We'll just print a little more here. Well, okay, fine, but that shows up in inflation. And so, but back to, how it's going to manifest. I mean, it'll show up first in the bond market. So, the bond market is a place where people go to park their money for long periods of time and get a return on it. If you have cash that you don't need for 10, 20, 30, 40 years, you can put it in a bond market and you'll get paid a certain amount of interest. And if the entity doesn't fail, you get your principal back at the end of the time period. They've just got use of your money in the interim. But when that confidence, that we all trust these fiat currencies because we trusted our governments, and there was a time when it was worthy of our trust, they weren't debasing the currency nearly so much. But now that they are debasing the currency more, the bond market is waking up and saying, hang on, wait a minute. You want me to hold this thing for 20 years and get paid 3 or 4% interest when inflation's running higher than that? And I think you guys are going to spend like crazy and create even more money. Nah, I don't think I want to do that. I'm going to sell my bond. And so, the act of them selling the bond means there's less demand for the bonds. And so the interest rate goes up. Well, once the interest rate goes up, that goes all the way across the curve, and everybody who owns a bond now, the interest rates are higher. And so when those come to be rolled over, the government has to pay more in interest expense. So they've got a bigger loss. So this is what I'm describing as a debt doom loop where, the government prints money, or the government borrows money to cover its deficits. It creates bigger bond balances in doing it. The bonds that get sold bring more supply into the bond market, maybe with no more demand. The way you balance supply and demand is interest rates go higher. Oh, interest rates are higher, 37 trillion of debt. We got to pay even more interest. Oh my, receipts didn't go up. Our deficit's even bigger. We got to sell even more bonds. And so it's a rinse, wash, and repeat. It's a negative feedback loop that gets worse and worse. And so what I'm watching very carefully, what I think is a big signal for the next crisis enveloping us and for the big print, therefore coming soon after, is the bond market. And we've seen little, squiggles around this. We saw Liz Truss have a problem with the British bond market in 23 or 22, I think it was. We saw our bond market in the fall of 23 went through 5%. The Fed came out with a lot of jawboning to get it back down. Said the rate hiking cycle was over. There talk recently about, a return to QE. The Treasury Department has been buying some of our bonds with some of the TGA, which is the government's checking account. So the Japanese 40-year bond the interest rate there has been going up very sharply. And that was always a currency in a country that had a big carry trade. So, all of these things are kind of starting to say to you, hey, there's smoke around the edge of the theater. Maybe there's a fire. And if we get to the stage where the bondholders realize, oh my God, they can never stop printing money and they're going to print a ton of it, this is a legitimate fire, they're all going to want to sell their bonds. And who's going to be the buyer? There won't be one. And so the bond interest yield will have to go much, much higher. And eventually, when you got your bond market falling apart like that, your currency is generally not far behind, because what the market assumes is that you'll get to a point where there'll be no buyers for your bonds, so you'll have to buy them yourself with printed currency, and that's extremely inflationary. If you print your own currency to buy your own bonds, that's just pure inflation. And so, That's kind of where I think we're headed. And if that inflation becomes acute enough, then we'll transition to a sound money standard. And meanwhile, in an inflationary environment, gold and Bitcoin are just going to be ripping. I mean, gold's going to 5,000, Bitcoin's going to 200,000. Both those numbers I would say within 2 years.
Is there a way for today's Fed to align incentives to avoid a future big print, or are they too deep in the hole at this point?
I don't know the answer to that. I mean, it's a political question. I think they're pretty deep in the hole. They might be able to try and correct it. I don't really know the answer. I think they're too deep, I guess is really my guess. You know what I mean? I just think that it's too far gone.
And so when do you estimate that this next big print will come?
That's a great question. I think within 18 months. I think if you kind of look at all the charts that show the debt and the underlying monetary supply growth, the separation between the two has gotten fairly large. It could get a little bit larger. It could happen tomorrow. I mean, we just don't know if something breaks. But I'm pretty sure that within a 18-month, 2 years at the most kind of window, it's going to happen. Now, I'm going to be embarrassed if that's not the case. But I think that even if it's not a big print, I mean, there's a possibility, and you're seeing some of this now, that they do a series of quote unquote little prints, just to kind of, and that's putting fingers in the dike. But I think eventually the dam is going to burst and they're going to have to do a really big print.
Hey, we won't hold you to that exactly, but we'll
Yeah.
be
Well,
looking.
that's fair. It's fair enough.
But Larry, as we were talking about before we even started the episode, I graduated from Harvard Business School, as did you, but I graduated a year ago. And during my 2 years there, I was never assigned to anything that seriously explored the cycle of excessive money printing that led to these boom and bust dynamics.
Or,
Um,
or Austrian economics for that matter, which is
Austria-
a really good model for understanding all this, right?
yeah, and
Uh,
it could have been in an elective course I didn't take.
sure. I don't think it was there anywhere because I looked for it when I was there too. And well, Harvard Business School is very much a piece of the establishment, and the establishment protects itself, and the establishment likes the system that it has. And we haven't gotten deep into Bitcoin yet, but the establishment doesn't. It's working for them. They're doing well. They're winning in this game, and so I think that's one of the reasons why many of them have kind of an antipathy towards Bitcoin. They just don't like it because it's like turning over the card table for their game, and they like the game because they're winning at the game. So that's kind of my explanation for why Harvard Business School hasn't been more open-minded to it. I mean, it's a really important monetary change, and it comes at a time that couldn't be more obvious and critical that it's needed, with all the financial shenanigans that have gone on. And yet, those who are in positions of power, they don't want to hear it. Jamie Dimon doesn't want to hear it. The Upton Sinclair quote, it's hard to get somebody to understand something if their salary depends upon not understanding it. I mean, and by the way, I think Dimon does understand it. I think he just talks negatively about it because he realizes that it would threaten the system that he's doing so well in. And I think Buffett falls into the exact same bucket.
So I mean, you've laid out the case very clear here, right? Crisis hits, there's money printing, that leads to inflation, hard assets really go up. To add some fuel to the fire, we also have this AI revolution happening
Right.
now, and there are a lot of projected job losses that will result in this revolution that's taking place. And I'm curious, how do you think that will further affect Fed monetary policy, and as a result,
Yeah, well, I
price
mean, on the positive side of the ledger, productivity is good, and the more productivity we get, the better the economy will perform, and so we might get GDP growth based on that new productivity. So, I'm all for AI, although it reminds me a little bit of the dot-com bubble. I think it's a little ahead of itself. On the negative side of the ledger, from their point of view, it relentlessly is deflationary. And if we have AI doing the work of lawyers, and if we have robots doing the work of factory workers, those are all salaries that aren't going to get paid. And those people who are earning those salaries today, it's dependent that they continue to earn those salaries so they can repay their debts. And so it's what Jeff Booth so brilliantly puts out, and I talk about it in my book, where we've got a system where you have to continually increase the debt and the credit, and you've got to increase the monetary base to keep the system running because the system's built on debt. And yet you've got deflation, which is very anti-debt, which is going to drive the price of everything down. And so the two systems, they're trying to achieve a differing goal. And the inflation, it's going to take. They're going to have to do more and more printing to keep the inflation going because all of the productivity benefits from AI are extremely deflationary. Do you see what I'm saying? So it's really kind of a problem. And I think that's part of what's going to force the hand of all these guys. I mean, we haven't talked about the fourth turning and the timing on all this now, but I really believe strongly, Charles, that between now and 2035, we're going to have a new monetary system, that there's going to be really big change that's going to take place in the next 10 years. We started with the fourth turning with 2008, and here we are. We're deep into it. We're 16 years into it, and it's accelerating. And so it feels to me like, we're going to either have a very big bout of inflation, or we're going to have a hyperinflation, or we're going to have some kind of outright debt collapse. And the outcome of all that is going to be a reset to sound money, which could either be gold or Bitcoin. But those are really the only two choices.
That is going to be very
It's going to be wild, right? Well,
very
and it's going to have an enormous impact on people who own those two assets,
yeah.
and a negative impact on people who don't, right?
Yeah. Well, yeah, we've talked quite a bit about the store value case for Bitcoin, but what
Right.
is usually less spoken about is the aspect of sound money or Bitcoin as a medium of exchange.
Yeah, sure.
Yeah, there's a powerful example in your book about remittances. You note
Yep.
that if all remittances move to the Bitcoin Lightning Network, we could potentially save 62 billion a year in
Yep.
transaction fees, which is massive, right? So why hasn't that shift happened yet? Because that would be that's a pretty big deal, right?
Yeah, it's a really big deal. I think it's just a matter of timing and education. I mean, the Lightning Network is, for those who aren't familiar, it's the thing that sits on top of Bitcoin that settles very quickly with very low cost. I mean, every Bitcoin block on average is being mined in 10 minutes. Lightning settles instantaneously. Of course, then it links back to the main chain, but for all intents and purposes, it settles the minute you push the button. And so it's very cheap. I mean, each transaction is less than a penny in cost. So you're buying coffee, and you're not even paying 3% credit card fee. And it works depending upon what you're doing, where you're doing it, and the dollar amount. It doesn't work for big transaction. There's not enough liquidity in the system yet. I've tried $5 and $10,000 transactions. It's not reliable at that scale, but for anything under that, it works beautifully. And it's really an alternative payment mechanism for people who are unbanked, or all you need is a cell phone and a Bitcoin wallet. And in a country like Nairobi, which has been racked by terrible inflation, 30 or 40% of the people there are doing it. They're using this because their current currency just continues to lose value. So they want to hold a currency that won't lose value, and Bitcoin qualifies. So, to answer your remittances question, I mean, I think it's just knowledge and time. I mean, it's happening, but I mean, there's an adoption curve. There's some good charts in the book that show the adoption curve and where we are. I don't know. I mean, when cell phones got adopted, or the internet got adopted, or PCs got adopted, I mean, we're still in that very early adopter stage where, yeah, people are doing it, but the world's not doing it. By the end of this whole thing, everybody will be doing it. It'll be just obvious you should be doing this, but that's not what's happening right now. We're still in the under 10% penetration stage. So, I think it's just a matter of time and the word spreading. And as that happens, Western Union is not going to have a money transfer business anymore. You know,
Be hard to compete on those low fees. But
yeah,
we wanted to touch a little bit on before we head to wrapping up on government and Bitcoin, right?
yeah,
Because
sure.
that's becoming much bigger conversation now. So Bitcoin grew out of sort of an anti-government ethos, and now sentiment across the board is that government should adopt Bitcoin. Partly because it's sound money, but also because it would help the price of Bitcoin go up. So, do you worry that Bitcoin principles are increasingly focused on price speculation as opposed to sort of the core principles that Bitcoin was founded on?
That's a really great question, and government adopting Bitcoin is another great question. I mean, I've had people say, "Hey, you don't want government to if you're an anti-statist, i.e., if you don't necessarily like big government, you don't want the government to buy Bitcoin because it's going to make them stronger, and we want weaker government, not stronger government." But I answer that by saying, well, yeah, except that if I look at kind of the three biggest governments in the world with nuclear weapons, China, Russia, and us, I'd rather have our government be the strongest of those three. So the whole idea of having a strategic reserve and having our government buy Bitcoin, that's okay with me. The government's role in this whole thing is kind of interesting and tricky. I mean, they originally ignored it, poo-pooed it, and that was one of the great concerns 5 years ago, talking to people. They said, yeah, it's a great idea, Larry, but the government's going to shut it down. Well, then the ETF got approved, and Donald Trump got elected, and the strategic Bitcoin reserve got put into place. And now it appears highly unlikely, at least in this administration, the government's going to shut it down. make a footnote there because there's something to come at the end of that. But the government should be, in my view, buying and stacking Bitcoin just like they buy and stack gold to defend their currency, and because I think this will become the future currency. Now, one thing the footnote is that we're in a red administration that's become friendly to crypto because crypto and Bitcoin people voted for Trump and helped support him, and he got educated by Vivek and others, and Bobby Kennedy, and so he now is a Bitcoiner, so to speak. I mean, I'm not sure he really fully is, but he's, at least he's not Elizabeth Warren, who hates it. But let's say 4 years go by, and let's say, JD Vance or whoever the next candidate is doesn't win, that whatever, Trump's not able to solve enough problems, and people go the other way and say, well, Democrats have promised me a lot of stimulation checks and help and this and that and the other and higher tax the rich. And yeah, I'm going to sign up for that. Well, then they could come back in. And, it turns out these monetary things are kind of being decided by the executive office. Monetary matters were supposed to be decided by Congress. That's what the Constitution says. But, Greenspan, or what am I talking about? Lincoln, created greenbacks, and FDR grabbed all the gold, and Trump just created a strategic Bitcoin reserve. These were all without a congressional vote. I mean, these were all just they did it by decree. So let's say blue team wins and blue team decides, hey, these guys in the sound money world, they're really messing us up. The dollar is weak. Gold is soaring. Bitcoin is soaring. All those people or speculators are getting rich. We need to tax that stuff at 90%, or we need to do a 6102 executive order like Roosevelt did and have them send it all in, and reset the currency. I mean, all those things are not impossible, in a different government leadership regime. And which is why, I always argue for Bitcoiners that having your own keys is important. I mean, they could decide to tax you at 90% and say they're going to confiscate your Bitcoin, but you can also have 12 words and leave the country and they can't get you. So, yeah, it's the government's role in all this is interesting. I will say this: I do know from contacts I've had in many places that at the highest levels of the government, they're very interested in Bitcoin. They recognize its importance. In particular, they recognize its importance vis-a-vis the competition with China. And China, it's an area where the U.S. could actually leapfrog China because China has taken the view that Bitcoin's not good. They outlawed the miners. They've been very anti-Bitcoin, and they've made a big bet on gold. And so if the U.S. wanted to leapfrog them, we should go to when we reset our monetary standard, which I believe will happen within a 10-year time frame. When we do that, we should reset to Bitcoin, in my opinion.
Interesting. So the U.S. has already established a Bitcoin reserve, as you
Right.
mentioned. If they actually start to accumulate, let's say they do, and other countries follow, and Bitcoin eventually becomes the world's reserve currency, do you see some sort of risk there? For example, if the U.S. already owns more gold and Bitcoin than any other country, the two main hard assets that could actually challenge fiat dominance, wouldn't that actually incentivize the U.S. to go even further with more money printing since there's no longer another hard asset?
I hear your point. Yeah, I mean, possibly, but until they really link the money to those two assets, the fiat, I mean, they've got a fiat doom loop going on. And yes, if they own more of the other assets, it'll make them look, generally speaking, better off. But they've really got to get all the way. They've got to take the next step, which is to link that fiat dollar to these sound assets. Because until they do that, if these assets keep going up in price, the faith in the dollar is going to get lost. I mean, it's already been substantially dinged. Trust is a funny thing. When you lose it kind of all at once. And so they could, if people lose trust in the dollar, that's going to be very, very bad for the U.S. government, except insofar as it owns a lot of Bitcoin and gold.
Well, before we wrap, I have two more questions for you here.
Sure.
And, the back of your book it states that most Americans and people worldwide understand that despite our remarkable technological advances, something is deeply wrong with the direction of our country and the world.
Yeah.
There are a variety of causes, and you wrote this book because too many people are missing the one principle underlying the cause. The money is broken. So, referring to the extraordinary stimulus measures during COVID-19, you wrote, this wasn't just a pandemic assistance, it was the greatest upward transfer of wealth in modern history,
Yep.
executed while America was masked and distracted.
Yep.
Why do you think America remains distracted through these repeated boom and bust cycles, and how can we all wake up?
Because they haven't read my book. Obviously, I'm being self-serving and trying to sell books, but I think, the average person just they work hard, they put money in the bank, they believe in the system, and for many, many years, the system was good and it was fair and it did work. But, like anything, it had cracks and it had fatal flaws in the way it was designed, and those cracks got exploited and those flaws got bigger. And now we're looking at a bridge that's, the foundation is crumbling and it's really kind of a mess. Do you know what I mean? And it's just not working the way it was intended to work. And so, and I think what's going on is, a lot of people feel that. That's what I said on the back of the book, but they don't really know why. And they don't necessarily know why because, there aren't that many people who are quote unquote monetary scholars. I wouldn't call myself a monetary scholar, but I would say I've read the work of all the monetary scholars. And what I can tell you is that this is a very, repeatable, well-known pattern throughout history where, empires get too big, they overexpend, they run deficits, they take on debt to run the deficits, they print money to cover the debt, and then ultimately the currency fails. I mean, this is, it hasn't happened with the world reserve currency in a long time, if ever, although it probably happened in Rome. The Roman denarius failed, but I mean, it's certainly happened in smaller countries, plenty of them. And so when you behave a certain way, you're going to have a currency crisis. I mean, Zimbabwe, Venezuela, Weimar Germany, Argentina multiple times, Brazil multiple times, China, Russia. I mean, after the wars, I mean, all these countries have experienced this kind of currency collapse. The U.S. just hasn't experienced it. I mean, we had a soft default, we had a collapse with the hyperinflation of the Continental, and after the founding of the Republic, we had a soft default with the greenbacks, but they were able to actually bring us back to the gold standard after that. And we had a further soft default when Roosevelt grabbed the gold and devalued the dollar in gold terms. But we still had the exchange standard for the dollar, so that hung around till 71. So it's been kind of a multitude of things that have happened, but Glass-Steagall got overturned in 1999. All the derivatives rules got changed, so Enron happened. The bank's leverage ratios got let free, so the banks got very levered up and created the housing bust. I mean, it's just one depredation after another, and they're now all added up to the point where we're kicking a can, and the can's really big. It's hard to keep kicking it, and so what I would submit to you is that we're actually going to have systemic failure of the currency, and that doesn't have to be hyperinflation. It could just be very, very high inflation. But to the point where everybody and their brother is screaming about it. And, we're going to take to the streets, and there's going to be a politician who's going to rise up and say, hey, I've studied history. The problem here is the money is broken. The money's not sound. We've got to return to sound money. Here's my plan. Here's how we do it. It's going to hurt one time, but after that, it's going to be good. And that person's going to win in a landslide, because everyone's going to be so pissed off and frustrated at the way the alternative has worked for them. You know what I mean? And that's kind of my hope. And that's why I wrote the book, to hopefully try and get enough people to be aware of this issue, so that when that politician arises, everyone will go, "Oh yeah, that's right. Well, yeah, we got to do that." You know?
So the anecdote is sound money. I mean, you clearly write in a nice phrase in the book: "Fix the money, fix the world."
Yeah.
We touched on this, but just to summarize it clearly for our listeners, what does that really mean? And what's the core message you want people to walk away with from that statement? And what could everyday people do about it?
Yeah. Well, the core message is that the problems we're enduring aren't blue problems or red problems, they're money problems. And the core message is we followed the wrong monetary system, and we need to change it and reform it. And we can and we will. And then in terms of protecting oneself, the core message is, we all get to vote at the polls, but sadly the two choices both kind of stink in certain ways, and nobody's up there as a sound money candidate. That'll change someday. But we vote in lots of ways in our life. One, we vote at the polls. We also vote with our money, and we vote with where we're going to put our money, where we're going to put our savings, what we're going to do, what we're going to use for transactions. And so I would submit that if you start to transition to a Bitcoin standard, and you put all your money into Bitcoin, or and you spend in Bitcoin and you save in Bitcoin, you're kind of depriving the old broken system of what it needs to keep going. And if we all did this, eventually the old broken system would just kind of wither away, and we'd be in this new standard based on Bitcoin. So I think that's what we all have to do. And that's the book is designed to show people that so that once they get conviction, they'll do that. Because if we get enough people doing that, we will return to sound money. That will happen.
Great. Well, awesome conversation, Larry.
Thank you.
Thanks for writing the book and thanks for joining us today.
Well, very nice to meet you, Charles. I look forward to being on future shows on I like that proof of thought idea.
Thank you. Thank you.
Yeah.
Wonderful. All right. Take care.
Take care.